much for joining this webinar all about giving equity to employees, and actually not just employees, but other people as well. Just going to hold on for just about 30 seconds or so, and then we can get started because there's always quite a lot of people that join quite late on. So I'm just going to close a couple of things. Sorry about that. The perils of working from home with the slightly dodgy Wi-Fi connection, which I'm sure many of you can appreciate. So thank you so much for joining again, but we can kick off now. A little bit of housekeeping to start off with. This session is being recorded, so if you do if you would like a copy, we will be sharing it with all of you sign up with your email address so we can share that with you too. And then also you'll see on the right hand side there is kind of a question box as well. So if you've got any specific questions, ideally related to the slide at hand, but if it's something that came a few slides ago, that's not necessarily the end of the world too. I will try and answer as many as I can at the end of each slide rather than in the middle, because otherwise it can disrupt the flow. So today, all about giving equity. We're going to start off with, I suppose, the why, and particularly in these times, there is a slightly more nuanced version of this as well. And then also the how much, and actually the how and the when and the what mechanisms as well. So I suppose to start off with is why give equity at all? And presumably you're a little bit further beyond this journey than most people are because you've attended this webinar. But if I was just giving it to anyone as to, trying to convince people to give up equity in their business, and they ask me, well, why, Matthew, why should I do that? Well, you'd be part of a massive growing trend to do that. Our data proves that people are doing this more and more. So to give you an example of that, we at SeedLegals also run a funding platform. As part of doing a funding round, you need to set aside whether you want to create an option pool. I'll talk about option in a bit more detail in a second, but basically the mechanism to give equity to employees. 2-3 years ago, only about half of the startups that were completing a funding round put in place an option pool. Now it's over 90%. And also, when you look at EMI schemes in the UK, they're growing at the fastest ever rate. So every year, not just the number of total EMI schemes increases, but also the rate in which they are increasing too. But that is just, I suppose, showing that you're part of a trend. What is the reason behind that trend? Well, it's all about this shift to kind of shared ownership. And you'll probably appreciate it's really, really difficult, particularly in the early stages, but at any stage in your company, to attract talent. And talent and hot talent is going to be effectively what separates out your startup from one that's going to be potentially successful and one that's not. So if you've got two options as a candidate and the salaries are roughly comparable and one offers equity and one doesn't, it becomes quite easy to see how. And also, even if someone does choose to join, so you've hit that recruitment even without giving equity, and we're just talking about your existing staff, well, it's incredibly expensive whenever you have staff turnover. So there was a sort of a stat on, I think every startup, every time a person leaves, it effectively costs a company £17,000. And I would argue for key employees, that's actually a lot more. And for startups, essentially, where it can really be make or break, it can be massively, hugely different there as well. So not just on the recruitment, but also the retention and also the motivation, feeling part of something a little bit bigger. You're not just working for a paycheck or potentially a bonus payment in the future. They are much more aligned with you as founders, as owners of the company as well, and they behave accordingly. So they're not just really, sometimes when you've got people laser focused on their bonus results, it might be at the detriment to the whole of the company rather than thinking holistically, what is the real benefit to the company? All right, so that's kind of the why. And essentially, a lot of people come to us at SeedLegals and they say, well, I need to give some shares or some equity to employees. And this is a pretty simplified version, but there are broadly two separate types of equity instrument for the purposes of this. It does get more complicated than this, but basically there's shares and then there's options. Everyone understands shares, right? You created shares when you set up your business. And often people come to us and they say, look, I need to be able to give some shares to my CTO, or I want to give shares to my employees or whatever. But sometimes that can be really, really difficult to do. Let's say hypothetically, your business was, making a lot of revenue, or your business had closed a funding round where it was valued at, let's say, £1 million, and you decided to give 10% to your CTO. Well, that 10% has just been valued in a transaction at £100,000 for 10%. So that's no different to giving someone £100,000 worth of cash, which, unless you're sort of giving someone Facebook stock or Apple stock or something that you could sell almost immediately, it's not a great deal, because I can't pay my tax bill that is incurred on me, £100,000 in shares of an unlisted company. So what's the option in that event? And that is options. Now, however complicated options get, and they can get really, really complicated, but essentially it's just the right to buy a share at a fixed price. And you can see that if, for example, you had the right to buy 1% of Facebook stock for 1 penny, that's effectively like owning 1% of Facebook stock. It is slightly different because you don't get the dividend income, but essentially it's a hugely valuable instrument. And then the advantage of doing options and not shares is it means that you're not giving someone this huge tax obligation up front. It's the kind of tax efficient way of doing things. And if you have done a funding round or have done significant revenues, more often than not, you're not looking to give out shares to people. You're looking to give out options to people. And that tax efficiency, there's kind of two goals when it comes to that tax efficiency. One is you want to defer any tax payment to the point where you're sure that it's worth something. If the company is listed on the stock exchange, well, then that's totally fine, or has been sold or whatever. You don't mind paying tax at that point because you can sell some of your shares to cover the bill. So that's goal one, is deferral until you're certain of value there. Goal two is trying to reduce the total amount of tax payable too. And we'll talk about different types of option scheme. EMI option scheme is kind of the way to go there, as really the best way of doing that. And separately, just to the tax consideration, options can be quite a lot less hassle. When you award someone shares, there's all of this consideration about vesting, and we'll talk about vesting later. But let's say if you made the shares conditional on working for a certain period of time, etc., etc., what happens when that person leaves? Do they go back to the founders? There's all of these added complications. So often as well, options can be a lot less hassle because there are no shares issued at company's house, no share certificates, etc. It's very easy just to say, well, this option has lapsed because these metrics haven't been met too. So that's the difference. Shares can be appropriate well before the company's worth anything. Options more or less for everything else. So we talked about options, right to buy a share at a fixed price. But people always kind of ask us, well, what are options? Do I issue a load of shares to go in an option pool, etc.? And also, do I have multiple option pools? So firstly, what is an option pool? Well, the shares haven't actually been created. So let's say if I have 1 million shares in issue, and I want to create a 10% options pool, I don't add another 111,000 shares on Companies House. I just keep it as a placeholder there of 10% of the potential shares as well. So they don't actually exist yet. And the thing to note here is you don't have to have multiple options pools for advisors, for employees, etc. It's all one kind of thing. So actually you can see actually on this cap table as well, it dilutes people once they are exercised, not right now. And you have this difference between, the existing shareholding, so what is actually there now, and the actual fully diluted percentage as well. Now, if you're doing a funding round, normally option pools are created. Created what we call pre-money. And so essentially what that means is it dilutes existing shareholders, not investors coming in that round, and the existing shareholders. Now, you might think that's a little bit unfair, but it's one of those things that investors really, really hate being diluted by the option pool. It's an absolute kind of no-go from their perspective, and it's actually easier to, and I talk about this at length in our term sheet webinar, but it's actually easier to argue for a higher valuation with a pre-money options pool than the reverse. So, in short, placeholder for shares, they don't exist. The dilution effect happens when they are exercised. Christina asks, can warrants be turned into options? Well, a warrant is basically one specific type of option that you have. So, and if you wanted to change a warrant into a different type of option grant, provided you had the consent of both shareholders, there's no reason why you couldn't. All right. So, so we have now and the thing to note here is that shareholders and investor approvals might be needed. So, for example, you need 75% of your shareholders to agree to create an option pool if you haven't done so already. Now, if it's just you there, well, that's super easy. But if it is you and 3 other shareholders, well, you might need to have that consideration there. And also, if you've got investors, so if you have closed the funding round but decided not to set up their option pool, the option pool as part of that funding round, you might need their consent too. So always bear that one in mind, that you might actually need consent to do that. Cool. And normally at this point we sort of ask, well, okay, I've decided that I want to give equity. I know it's going to be options and not shares. How much should I give someone? And essentially, there is no right or wrong answer to this question. There are some principles that you can be guided by, but actually it's up to you to kind of think about that. And the earlier in your journey, the larger the option grant should be, obviously, because you are compensating for risk. If you're joining a company with just 3 people versus one that's, got tons of revenue, has got 100 people, that is clearly much riskier proposition. The thing to note here is what you shouldn't do is pick numbers out of thin air. And often people say to me, look, what's the appropriate amount to give a CTO at a seed stage? And it's just, I can't give an answer to that question because there are so many options as well. So there, essentially what I always encourage people to do is create a formula to work it out what they're going to do. So that might be, are they taking a haircut compared to what they could earn in another job? How important are they to the business? How long will they be of critical importance to the business? And using that formula, you can feed that in to work out what percentage is appropriate for them and anyone else in your team as well. So really, really important. Don't pick numbers out of thin air. Come up with a formula to work out. Normally as a multiple of salary works quite well, particularly if there's a compensation effect as well. And remember, the earlier, the larger. But yeah, there's never a right answer to say a salesperson at this stage gets 2%. It doesn't really work like that. All right, I've got a few questions, so I'll try and tick some of them off. So Andrew says, what's the difference between vest and exercise of options? So basically, if an option is vested, I then have the right to exercise an option. So I don't have the obligation to, but if I could write to the CEO and say, I want to exercise an option. The exercise itself is the actual process of turning that option into a share. So just because they vest doesn't mean they are turned into shares at each quarter. It basically just means the option holder has the right, if they would like, to turn them into shares. Akin says, if you have 75% shares and want to create an option pool for a round coming up, is that actually possible? Yeah, absolutely, but it might just make easier sense just to create it as part of the funding round. It makes no real difference there. Rory says, is it the same process when issuing shares to issuing advisory shares? Yes, the principles are roughly the same. It's slightly different in that you don't use an EMI scheme, you use an unapproved scheme, but you should definitely be doing options if there is value in the business. Kate says, do you have to time your option pool creation to a funding round? No, absolutely not. You can create one before a funding round or after a funding round if you like, but most people just do it as part of that. Mohammed says, can you also talk a bit about the framing founder shares as options too? Is that not issued, or is it issued but can take it? So founder shares are issued if they hold them already. So it's a slightly different thing. This is for new people coming in after the company has already been incorporated. A couple more now. Can you carry forward an option pool from pre-seed to a seed round if none have been exercised? Yes, it more or less stays with you as you go through. So if you've not used any of it, you still technically have that option pool. And then lastly, before I move on, does the employee become immediately liable for the tax on the value of the shares as soon as they exercise? I'll come on to that in a minute. Okay. There's a few more questions coming in. I will answer them, but I'll just move on and come back to some of them afterwards as well. All right. So who to give as well. So we talked a little bit on advisory shares too, and I talked a bit on, mainly about employees too. Now, it can sometimes make sense in the earliest stages to give equity to employees, to advisors, but it's typically a really, really bad idea. And I often have this conversation with founders about, I've got these 3 advisors. I want to give them each 1% each and whatever. And that's a huge amount of equity to give away to an advisor. And, generally speaking, talk is cheap and implementation is expensive, as the saying goes. So if you do have an advisor that is providing great value to the business, sure, you can think about giving some equity, but I would again price it just like you would price employee options based on the value that they are providing. Don't just say, oh, it's an NED, so he expects 1% is typical. And then secondly, the more advisors you have, the more you dilute your existing experience pool as well. So don't really, I really hate anyone that gives equity to more than one advisor. Not I hate the person, but just I just don't like the concept whatsoever. All right. So option schemes. So these are the rules under which options are dealt with. If it's just a one-off, the rules in which options are dealt with. There are different types with pros and cons. So we're going to talk about the 3, which is exit only, time-based vesting, and milestones-based vesting. And then in the UK, you've got your EMI scheme. That's for employees working 25 hours a week or 75% of their working time. And also your unapproved options. So that would be for advisors, for consultants, anyone else going through too. Cool. I'll answer some of the more questions as well. So RAM says, are options part of the SEIS pool? No. So Ashish says, can you issue reverse vesting shares for founders? Yes, you can, but bear in mind what I said about if the company has value, then you should do options and not shares. But if the company, if they have the shares now or they don't, they don't. Archie says, do you have to do an option pool as EMI? So you do need an option pool to do an EMI scheme, yes. Randeep says, if you issue shares to a new joiner without formal payment, does that reduce the capitalization of the business for existing shareholders? It doesn't reduce the capitalization technically, but it does dilute them, yes. And then Peter says, at around seed stage, how much you recommend contributing to EMI options? We have 4 founders, so it's hard to give more than 1%, but post seed value, so quite a considerable sum. I normally think on the seed stage, anything between a 5 to 10% option pool is fairly typical. The way I like to think about it when it's when you kind of trying to size the options pool more generally is think, well, how many potential options would I use between my round now and a potential round in the future? So let's say if I might use 3.5% between now and there in the future, then top up with a little buffer. So then you might want to say instead of 3.5%, it's 5%, just because you never know. And then that's a good sort of rule of thumb of thinking about it. And then yes, absolutely, we will send the recording of this webinar as well. So moving on now as to sort of what is EMI. So I mentioned earlier that's for employees in the UK working 25 hours a week or 75% of their working time. Stands for Enterprise Management Incentives. And it is by far the most tax efficient mechanism of giving equity to employees. It involves agreeing a valuation with HMRC, which I'll talk to you about. And then for those of you that have done an EMI scheme before, there were some new rules that were implemented in 2019 that made it a little bit more tricky in agreeing that valuation. But that's why we built SeedLegals as well. So how it works. So essentially, I'll talk about that valuation now. So let's say if your funding round valuation or the true valuation, if you've not done a funding round, is £1 a share. The objective is to try and argue with HMRC the lowest price possible for your share. So you might want to propose, well, actually, instead of £1 a share, we think it's worth 30p a share because of all of these reasons. They might not have voting rights, all of these kind of potential things as well. Now, let's say we go and we sell the business for £10 per share. That person now has the right to buy a £10 share for 30p. So if you remember back to what an option is, it's the right to buy a share at a fixed price. So that person can now buy a £10 share for 30p. They make a £9.70 profit. And this is where the EMI scheme is so amazing, is that it's taxed at the 10% entrepreneurs relief rate, compared to north of 45% if you weren't doing it through an EMI scheme, which is potentially, if you're on a big exit, you're pushed into the highest tax bracket as well. So it's the absolute no-brainer scheme if you're trying to give equity to employees. And often people want to look at the pros and cons of each scheme, of growth shares, of CSOPs, all of these fancy nuanced ones. But essentially, if you can offer EMI and the person can receive EMI because they're an employee of the business, it's by far the thing to put in place as well. So yeah, it's EMI scheme is for full-time employees. For contractors or anyone not working full-time, they go in what we call the unapproved scheme. So you can still give them shares, but they would be taxed at whatever their income tax rate is, not at this 10% rate going forward. All right. So who can offer EMI? You've got SEIS and EIS businesses. So you have the great... if you have closed an SEIS or an EIS funding round, you can definitely offer EMI as well. If you're not doing a funding round, or if you haven't done that yet, please have a look at the restricted activities. There are certain things where you can't offer EMI options. For example, if you're a bank or an estate agent, etc., there are certain restricted activities, but most tech startups will be definitely eligible as well. You can do £3 million in total in the lifetime of the company of EMI options. That's that value that you agree with HMRC, and the maximum value of £250,000 to an individual. and also 30% equity max to an individual. So you can't, for example, give 50% to someone if they're a late founder, but 30% can definitely be through the EMI scheme as well. There is a more comprehensive list on the SeedLegals blog as well, but that's kind of the main considerations to think about. So yeah, that's the 30%. Nick said, Rikesh says, if you had pre-seed raise and offered options after that, would the minimum value be the valuation in that round, or could it be possible argued? Yeah, absolutely, it can be argued lower, and we've got a great valuation report that can do that. I'll show you how that works at the end of this. Nick says, can EMI be allotted to US residents? No, they go in the unapproved scheme, but you can still offer them options, and it's and then David says, how does the 10% EMI tax rate compare that to that founder saying? It's the same tax rate, exactly the same tax rate. And Archie says, isn't EMI like 14K to set up? No, at SeedLegals, we've managed to make it happen for 2.5. But anyway, I'll move on from this now. Great discussion, so keep them coming, but I'm conscious to keep moving through. Cool. So yeah, I talked about there are various different types of non-EMI schemes, growth shares, C-Shop, but if you can offer them, EMI is the only game in town that makes sense as well. So I'm going to talk a little bit now on the kind of different types of option scheme as well. So we talked about, the broad brush of whether it's EMI or unapproved, but actually what are the mechanics on how they work? How do people actually earn their shares as well? So the kind of most obvious one is what we call an exit only scheme, which is kind of really simple, kind of does what it says on the tin. And it basically just says, well, look, if you're here on an exit, that's great. You can exercise some of your options, but if you've left before an exit, sorry, you weren't sticking around long enough, so it would lapse. Makes sense, right? The advantage here is it's really, really simple to run. You can just it's really, really simple to run. You can just sort of stick your option paperwork in a drawer and just be like, oh, when we sell the business, we'll get it back out, see who earns what, and then that's done. So you don't have to track anything, etc. But I suppose the disadvantage there, I've just moved on my slides. The disadvantage with an exit-only scheme is it can sometimes just objectives forever change in a startup, and essentially. You might never exit, so you might be very happy to keep on with dividends in the business, etc. You might also demotivate your employees. Your exit might be many, many years away. I just have to look at the example of, well, I won't use WeWork because that, the argument there is maybe there shouldn't be any value for option holders there. But Airbnb, let's say, it's taken Airbnb much, much longer to get to an exit. And a lot of these people are just, can't move on for their careers, but they've worked there for 13 years and haven't been able to exercise their options as well. Historically, it was kind of just what law firms suggested as the option because it was so simple and it essentially wasn't something that they thought was worthwhile, and they didn't really understand the commercials of it, and it's just the simplest one for them to do because they don't have to work out who earns what at what time. Anyway, moving on from that. I've sort of lost my milestones-based slide as well, but there's also a milestones-based vesting schedule, which is, again, quite simple. You hit this milestone, let's say that's £1 million worth of revenue, and then you get to exercise your options. If you don't decide to exercise your options, if you haven't hit the milestone, if you haven't hit that revenue, you can't exercise your option. So the advantage with a milestones-based vesting schedule is obviously it aligns with performance. But I suppose, again, the disadvantage is objectives are forever changing in a startup. And that essentially means that, I'd invite you to look at what your objectives were 2 years ago compared to now. They're likely very different. And with exit, with option grants, you're trying to look for the sort of long term, the 3 to 4 year kind of time window. So it's really, really difficult to set milestones at that kind of thing because objectives change so often. And also, it kind of works for stuff that's really measurable and achievable. For example, sales roles or marketing roles where you can say exactly that 1 million revenues hit or 100,000 app downloads is hit or whatever it might be. But what about for technical or operations or HR? These ones that aren't as easily measurable can be really, really difficult. So what's our preferred route and where do we point most users to on this? What we call time-based vesting. So that is option holders earning their shares over a period of time. 3 to 5 years is typical, can be more, can be less. The advantage is it best aligns employees with founders. So if you have closed the funding round and your investors insisting on a vesting schedule for you, you will be on a time-based vesting schedule just like them. So going back to that theme that we talked about earlier on it being motivational and the ideal for retention, this is kind of what you want to do, because the whole purpose of an option scheme is to motivate, recruit, and retain. And if you are setting up a scheme that is doing that less well than a time-based vesting scheme, well, then actually kind of what was the point of doing that in the first place? What's the downside? Well, historically, it's been a little bit more difficult to run because you have all people joining at different times, might have different vesting schedules. So it's really difficult to keep track, or historically, it was really difficult to keep track on who earns what at what particular time. But the good news is with platforms like SeedLegals is we've essentially automated a lot of that process and therefore make it much, much, much simpler to do. So got a few questions there on the pricing of EMI. So I'll talk about SeedLegals pricing, but it is about 10x cheaper than what you suggest, Archie. Martin says, what is the drawback of issuing an option pool at the pre-seed round at 10% as opposed to staircasing? Essentially, it's the price that your investors pay. So if you create a bigger option pool, that lowers the price per share that the investors pay. And it's essentially the founders are taking the full dilutive hit of the option pool compared to if you staircase it. And then 5% the founders take the hit and 5% the founders and the first round investors take the hit. Kate says, is the exit approach SEIS, EIS compliant? Yes, it is. Saqib says, are founders able to buy back EMI option pools from employees who leave? Happy to sell back at a discount pre-exit. Founders are able to buy, but there's a difference between the founders being able to buy and the seller being, the option holder being obliged to sell. The option holder can't be obliged to sell because the shares have to be what we call unredeemable for it to qualify for EMI. So, you can't, for example, say, hey, we're going to pay you, £1 a share for your shares once they have been exercised. Andrew says, can you offer options at nominal value, i.e. below the market value? Does this change the tax outcome? So yes, absolutely. Essentially what happens there is, let's say if your funding round share price was, your EMI price was £1 a share, you offer them at the nominal value. So let's say that was a penny and you sell for £10 a share. Well, the difference between £1 and £10 is taxed at 10%. But the difference between £1 and a penny will be taxed at their income tax rate. So the option holder will still be better off, but they'll obviously pay a higher proportion of that the cash that they're receiving as tax between the nominal value and the market value. And then Naboth says, can you have a hybrid approach, i.e. milestones and time-based vesting? So essentially, absolutely. I always like to think that time-based vesting works best, but there can be a place for milestones. And where I see that work best is people coming to you when you might say someone's on a 5-year vesting period, and then you say, you've done an absolutely amazing job, or if we can get to this point here, etc., I will accelerate this vesting. So maybe turn that 5 years into 4 years. So you have kind of hybrid milestone and time approach, but you're not disadvantaged. You've got a sort of performance element there, but you're not disadvantaged with the fact that objectives forever change in a startup, etc. And then Rafiq says, do employees who get shares from the option pool exercise any sort of voting rights? Really, really good question. So it depends on the share class that you've decided to offer out. Now, we normally recommend a non-voting share class to employees for a number of reasons. One is we talked about agreeing that HMRC valuation earlier, and it's easier to get a lower valuation if they're a non-voting share class. Secondly, do you want employees that have left the company having voting rights in the company at all? Probably not. And then thirdly, just third thing to note here is while they remain options and not shares, regardless of whatever the share class is once they've been exercised, there are no voting rights. So yeah, absolutely. It's kind of up to you what kind of share class you offer them, but we recommend a non-voting share class for most incidents. All right, moving on. So what happens when an employee leaves? So you have this kind of distinction between a good leaver and a bad leaver, and it does get more complicated than this, but in the broadest possible sense, a good leaver is someone that parts the company on good terms, voluntary, becomes incapacitated, etc., versus a bad leaver. That might be someone that is fired for gross misconduct, committed a criminal act, something along those lines. In an exit-only scheme, it kind of doesn't really matter if you're a good leaver or a bad leaver. Because it's an exit-only scheme, that option will lapse almost all of the time. For those milestone and time-based options, well, if they have hit the milestone or if they've passed their time, they've got 90 days to exercise their options to benefit from EMI. So this is a thing to note, is there is normally a window that you design in your scheme, which is when someone leaves the company, how long do they have to exercise their option, turn it into a share and pay that price per share, that consideration that we talked about earlier to get the share. And most schemes set that to 90 days so the person can maintain the EMI benefit. You can, if you would like, make that longer. Maybe the employee can't afford to exercise their option, then you might want to make it 1 year, 5 years, something like that too. But in that instance, if someone hasn't exercised within 90 days, it will then cease to be an EMI option and will now be an unapproved option. And then they will obviously not benefit from the 10% tax rate anymore too. And on what happens on an exit? So again, it's a decision for your scheme. But normally what happens is, if it's a time-based vesting, all options will vest, because you don't want to penalize someone who, just because there was an earlier than expected exit. With milestones, if it's an early exit, the board can kind of choose, if milestones not hit, they might decide. But there's often a provision for time working with an acquirer. So let's say if I had some options and they were vesting over 5 years, but after 1 year, the company was bought by someone, well, what happens to those remaining 4 years that I haven't actually worked for yet? Well, then the company might say, hey, Matthew, great news, we've exited. We're going to allow you to keep all 5 years worth as well. But the provision in your option grant is you have to work for 12 months for the acquirer to get those additional 4 years if they want you to. So that's normally, normally 12 months is the standard there. Can be more, can be less. Most often it's more, but that's just so not everyone, you don't want to be in a situation where everyone leaves the day after an acquisition as well. So Antoine says, my employer takes options back when someone gets fired. He says it's somewhere in the contract. So that's what we call an exit-only option that we talked about earlier, which means if someone leaves the company, then the option lapses. It kind of depends on whatever the scheme rules are as well. Cool. All right. So I talked about the pricing as well. So it's £1,500 to set up an EMI scheme and £1,000 for evaluation. I would be delighted to answer any more questions that you have as well. But before I do that, I would just love to show you SeedLegals quickly. So I'm just going to share my screen with you and just show you how it's really, really simple and quick to set up an option scheme on SeedLegals. So let me just go to my dummy company. Perils of online demos are that they're a bit slow. There we go. So it's really, really simple to set up an option scheme on SeedLegals. I can create an EMI scheme for employees, unapproved scheme for everyone else that we talked about, select the share class. So, decide what rights it has, whether it's voting rights, etc. And then So then I'll just make that A ordinary, click confirm. There is the qualification list for EMI options that I talked about who can benefit as well. And then you can actually set up your EMI scheme exactly how you'd like. So, what period of time it was going to vest over, or whether there's going to be a cliff, what happens during an exit, etc. Whether it's an exit-only option scheme or it's not. How long after someone leaves can they exercise their option? And all of that stuff that we talked about is covered under this too, and there's a few more questions. Once that's done, the platform will automatically generate for you your option scheme perfectly bespoke to exactly how you want the option scheme to work. And then the next step after that is you kind of move on to the EMI valuation. So this is going to come up with the option scheme. My internet is clearly being a little bit slow right now. It's normally an absolute breeze, but we'll just wait until that goes up so I can actually show you that the thing does go live. So there we go. We've got our EMI option scheme rules designed exactly to the spec, and then we can go on to the EMI valuation as well. So this is a really, really nifty bit of kit. It's actually the only thing like it on the market where I can go and I can create my valuation. I can input some details, whether I'm pre-revenue or not, the assets on my balance sheet, the date, etc. I can put on various other certain things as well, but if I just keep it to that for now. And then once that's done, the platform takes all of the data from Companies House on who owns what in your business, all of the data in your option scheme, and that financial information that you've just provided, and create this EMI valuation exactly to the specs that you need. So this is going to load up for me as well now. Just going to get some water. Sorry, it's a little bit frustrating it's taking so long. Cool. So then this summarizes the history of the company, whether there's been any share transactions, because it would take all of that data from the cap table, values the business on 3 different bases, so net assets, earnings, gross profit, and then also if you've taken away any share class rights as well from the cap table, it ascribes a discount to each of those to get to your HMRC EMI valuation. It's been used well over 100 times and it has amazing success rates, so I'd strongly encourage you to use that. That gets sent off to HMRC. They take about 1 to 2 weeks to get back, and then it's just a case of granting options to individuals. So let's say if I was going to give Adrienne here some options, I can say how many. I can say, great, HMRC came back at 10 pence a share, and then in one click, the platform will create the option grant for Adrienne. It has the strike price already agreed with HMRC, and everything can all get signed automatically on the platform. You don't have any Word documents, you don't have any signatures. Everything is all managed in one place. So with that in mind, I'm going to stop sharing my screen and answer some more questions. Andrew says, can the company help employees loaning the cash for either exercising their options or for their tax liability? They can't really loan it because that would be taxable in itself, but the company could grant it a nominal value to help, but that's more or less, and increase their salary potentially to cover it. But yeah, that's more or less the extent of it. David says, if someone exercises their options and the company is not publicly trading pre-exit, who can they sell their shares to? How does that typically work? How do they realize the value of their shares? Well, there's a number of options. One is you just wait till an exit and then get it. The second one might be, for example, wait for a funding round, and then more people might want to do that as well. And then the third one is, well, it depends on the articles, but they might want to sell it to a third party, so another investor, another shareholder, etc. So those are kind of the options. Essentially, what I'm encouraging people to do is to not have some kind of agreement where people, have promised to buy them at certain change. But yeah, essentially, you need to find a buyer, either whether that's through an exit, a funding round, or a third party as well. Neil says, once an option is exercised, do employees keep the shares? They then have the rights to sell them. So it depends on the articles whether they have the right to sell them. So you might have in the articles that someone won't be able to transfer their shares potentially, and then they have to wait until an exit. But most of the time, they do have the right to sell them, just like any investor would in the company. Rikesh says, at what point does the employee become liable from the tax on the value of the shares? Is it immediately on exercise? It is on exercise. That is a tax event in that tax year. It can sometimes be deducted through the payroll, so therefore the tax is immediate, or else it's adjusted by a tax return form whenever that tax return comes in. Andrew says, if I'm not doing an EMI scheme but an unapproved scheme, do I still need an EMI valuation? No, you just basically skip that step. So you just create the unapproved scheme, skip the valuation step, and then you just go and grant options to individuals. With an unapproved scheme, you don't need you can just set the strike price to whatever you like, and there's no considerations there. Ashish says, will someone from your team be available for no additional cost to walk us through the final setup dealings with HMRC if needed? Yes, I'm really glad you asked. Everything on SeedLegals, whether it's an option scheme or anything else, comes with our unlimited support. So whether you need 1 call or 10 calls, that's all covered. There's no kind of billable hours. We try and do things completely the opposite way to a law firm. What I suggest is when we send you the recording of this, which we'll do as a follow-up, if you could just reply to us and say, hey, I'd love to talk about setting up an EMI scheme, we can connect you to the right member of the team to do that. Chris says, can the valuation tool be used at any time in SeedLegals or just as part of EMI scheme setup? Well, it's one thing to note is this isn't a valuation tool to try and justify your company to investors. It's been specifically set up to value the business basically trying to argue for the lowest possible value. So if you're trying to use it as like a way of justifying it to investors, you'll probably be quite disappointed because the objective of it is not there. So therefore, we only really encourage use of it when you're talking about set up an EMI scheme. Archie says, yes, I really rate SeedLegals. Very well done. Blah. Thank you so much. Though had to get shareholders agreement and disclosure letter signed on Panda Doc instead because a number of investors didn't like questioning that was being asked. Happy to share more feedback as user on the platform. Yeah, please do share any feedback that you have. We sometimes get investors that don't really like joining the 21st century until they've used it once, and then they become our fiercest advocates. But yeah, no, we'd appreciate any feedback as always, and we look to iterate on it very quickly. Kevin says, what does this cost to create through SeedLegals? So the cost is split up into two. It's £1,500 to set up an option scheme. So that's an EMI and an unapproved option scheme. Or if you're just doing an unapproved option scheme, it's £750. And then it's £1,000 to do the EMI valuation. Ram says, is there a standard formula for calculating the share valuation? Well, it's kind of 3 separate formulas. So yeah, it's based on the net assets. So that's quite simple because it's just the net assets may be discounted for a few things. Then there's essentially it's a multiple of whatever the revenues are, or the gross profit is, or the net profits as well. And that's a multiple depending on how quickly they're growing. So if a company is growing faster, you'd give that a bigger multiple than one that is growing slower as well. Morgan says, is it common practice to give a probation period to co-founders before issuing their shares when the shares are the sole retribution for their work? Yes, we don't normally call it a probation period. What we call it is a cliff. So you might have seen it when I was setting up an EMI scheme, but there's a kind of a cliff period by which if someone leaves before their cliff period, they don't get any of their equity. So I always encourage all founders, rather than all of you equally, to put that in place as well. Andrew says, if I have late joining co-founders which want voting rights versus employees for which we want non-voting rights, does that mean we need 2 EMI schemes? Yes, technically it is. You do, but there's no additional cost for doing 2 EMI schemes on SeedLegals. So once you've created one, you'll be able to create another one for no additional cost. Rory says, can you raise funds from investors prior to being SCIS approved? or is it, it's not really an equity question, or is it advised to wait the 4 to 6 weeks for the application to be accepted? If your investors are willing to transfer the money, then it's on them. The SEIS Advanced Insurance is a comfort blanket for them. If they're willing to transfer the money before then, go for it. Glenn says, is it different with share options if I'm working with team or of freelancers? Yes, instead of using the EMI scheme, you use the unapproved scheme because they're not employees. But other than that, I would treat it more or less the same way. Oh, wow. The questions are being asked more quickly than I can answer them. Caroline says, when you create the terms for the option pool, will all of these apply to all employees given options, or can you have different terms for different employees? Yeah, great question. So the option pool is kind of the option pool, which means you can say, 1% of it is going to you, which is going to vest over 5 years. 1% is going to you, which is going to vest over 3 years. Yours is going to be a voting share. Yours is going to be a non-voting share. So yeah, the option pool is kind of a blank canvas. And then the scheme is the mechanism for giving it to an individual, which is where you outline the different terms. But absolutely, you can have different terms for each employee. Rafiq says, let's say I'm keeping 20% pre-money employee option pool with the plan of assigning these shares only when I find a perfect employee. What happens to this 20% until I find the perfect employee? Well, it's like they don't exist. So if you've got a 20% option pool and you've not issued them to anyone, it's essentially like it doesn't exist. And if you, for example, sold the business, then it's like they never happened. The exception would be if you had done a funding round, because if you've done a funding round, then the share price investors will be based on that 20% option pool. So be a little bit careful there. Pavel says, what should I do if I want to receive equity of a company which is in crisis? I want to join not just as an investor, but as an active player and CEO. The founder will not be involved at all. How can I receive equity of C Corp without paying for shares? Well, basically options are the way to go. So going back to the point, you kind of want to, you will want to get options through an EMI scheme. They will be vesting over time, so you won't get the shares straight away. But that is definitely the best mechanism, because you certainly don't want to get a tax event on a company that's in crisis. You want the situation where there's potentially huge upside if you manage to turn it around, but you don't want a tax liability up front. Martin says, what if you've issued an option pool and haven't used any of it until the next round? Can you downsize it from 10% to 3%, for instance? Yes, you can. But you can if it can get a little bit complicated because you've authorized it from the purposes. You can reduce it. So long as you get the other shareholders to agree, then that's fine. But Antoine says, is there a typical length of the vesting period for the co-founders? 3 to 4 years is pretty typical. It's normally probably about 1 year shorter than employees. So it might be, instead of employees, normally 4 to 5, co-founders 3 to 4. I think because co-founders can sometimes be reset if you've done a VC round or whatever. And I think the last question for now, but do keep them coming if there are any more. Alan Glass, it's a great point of the unapproved option scheme versus growth shares. So I don't really like growth shares. The main benefit of a potential growth share is you can, if you're a consultant, say, you can get a 20% tax rate on your options compared to a 40% tax rate. So in theory, it's an advantage, right? But the problem with growth shares is you have to do two things. One, it's pretty complicated articles of association changes, which is not the end of the world, but if you're only doing it for 1 or 2 people, it's quite a lot of work for not a lot of upside, and I'll explain why in a second. And then I suppose the bigger point is, with the growth shares, you need to set a hurdle. So that hurdle is normally way above whatever the company is worth right now, and the person is only within the money when the company is above a certain value. Otherwise, if you issue growth shares at below the existing share price, or only a little bit above, then that's like a tax event as well. So let's say if you've set a hurdle which is double whatever the company is worth now. Yes, in theory, any upside is going to be taxed at 20% versus 40%, but because you've got that hurdle, you have to 5x the value of the business for the growth share to be quids in, because of that. And so therefore, for that reason of you have to 5x it anyway, plus it's a really nice problem to have from an unapproved option point of view. If you have more than 5x, and you might be slightly worse off from a tax point of view, plus the fact you don't have to make all of those articles amendment changes and it's all complicated, is why I almost always point people towards an unapproved option scheme instead. Archie says, we're looking to set up US offices by a UK company. What are your thoughts? Best structure incentivized by a US CEO? I'm Matthew, but so if you're doing it in a UK company, then it's still going to be unapproved options if the top co is still in the UK. But yeah, there are some complications when it comes to the US, especially from a tax point of view. Yeah, drop us a line on that one, and we can advise once that person's joining. But there are some careful ones. But in short, you want an unapproved option scheme, but you want to kind of align it with the EMI scheme as well. All right, Rafiq says, out of context question. What else? In this crisis situation, should seed round companies be protective about their equality? I presume you mean equity, not that equality isn't important, or should they take cash even at a low valuation? So my view on this is, yeah, fair enough. So my view on this is, look, take whatever money you can get, because there might not be a tomorrow, and you can always fix this later. So if you have diluted yourself massively, which is what was needed for the business to survive, yeah, it's not ideal, it's not great, it could make more things difficult in the future. But if the alternative is potentially risking going to zero, well, that's clearly better. And the good news is with options is you can kind of fix the problem later. So let's say if you get massively diluted as part of this round, and then some VCs come to you and go, hey, Rafiq, you've been diluted massively, so we don't think you have the incentives in place. Well, you can actually benefit from the EMI scheme yourself. So get the cash in now, fix it later, because there are ways of fixing it later if there is any doubt of your company surviving. If you are quite confident of your company surviving, that does change, but I think it's very uncertain times. Rory says, if I have started a company with contracts in place for all co-founders, but then I decide to change the name and form a new company, can I backdate the previous contracts, or do I need to form new ones, as I don't want to affect the vesting schedule and the cliffs in place? You do need new contracts because it's a totally different legal entity that will need to sign. But what you can do is you can just set the same vesting schedule. So you could, for example, if someone's already been working for you for a year, set it to a 3-year vesting schedule and to a 4-year vesting schedule, or something like that. Or you can put a clause in saying, X amount has already been vested to account for that. But yeah, it does need to be a separate agreement. All right. Any other questions? Glenn says, I'm a little bit confused between vesting and a cliff. Okay, so a cliff basically is the amount of time that needs to pass before you vested any options. So let's say if someone was on a 4-year vesting period with a 1-year cliff, well, if they were there for 11 months, they wouldn't have exercised anything. They wouldn't have anything. But if they'd been there for 12 months, they would have 25% of whatever was granted. That's why it's called a cliff, because you get a big amount all at once to do that. All right. Thank you so much for that, guys. As I meant, and it's bang on the hour mark, which is groovy. Thank you so much for joining. If you enjoyed this, please let us know. We're actually looking at expanding our content a little bit as well. So whether that's maybe R&D tax credits, maybe that's certain other things, please let us know if there's anything that you feel we could really offer some value to, because we are looking at doing some more content. If you've enjoyed it as well, please email us. We love the feedback as well. Shout out on Twitter, whatever it might be, as well. But yeah, let us know, whatever. I will, if it's not me, someone else will send the recording of this webinar, which should have the questions in and the answers as well. But if it doesn't have the answers in, I've repeated all of them, so hopefully that's pretty clear as well. All right. Thank you so much. I will bid you adieu.